Namaste friends. Dealing with the property has many angles to it. Today let's examine the provisions in the Income Tax Act which have an impact on property transactions. When we say property transactions, first let us try to understand meaning of the term property. Now what is a property? Property is any asset. Now Income Tax Act doesn't use the term property for the purpose of taxation. It calls it as capital asset. Now, transaction may be anything, buying, selling, or giving a gift, inheriting, anything. Now, let us examine these provisions in the subsequent slides to see whether all these transactions have any income tax angle in them. Coming to the term property, now Income Tax Act defines the term in section 214 as capital asset. Now it says property of any kind is a capital asset. That means dealing with any property, any kind of property attracts the provisions relating to Income Tax Act. Of course, section 214 provides certain exceptions from the definition of the term capital asset, like stock in trade. Any goods which are held for the purpose of resale are called as stock in trade. Or personal effect. Any mobile property which is used for personal purpose is called as personal effect. And agricultural lands. Now all these assets are exempt from the definition of capital asset. That means they are not treated as property for the purpose of taxation. Now when I said agricultural land, it may be either rural agricultural land or urban agricultural land. As far as urban agricultural land is concerned, it will not be treated as agricultural land if it is situated within the limits of any municipality, corporation, etc. or if it is situated within a distance of 2 kilometers where population of such municipality, etc. is between 10,000 and 1 lakh, or the land is situated between 2 kilometers and 6 kilometers where the population is between 1 lakh and 10 lakhs, or if the land is situated at a distance between 6 and 8 kilometers, okay, where a population is more than 10 lakhs. Now in these cases, the land will not be treated as agricultural land, and the buying or selling would attract the provisions relating to Income Tax Act. As far as sale of property is concerned, the provisions relating to capital gains are attracted under Income Tax Act. Sale of any property results in capital gains. Now capital gains can be either short-term or long-term. When an asset which is treated as short-term capital asset is sold, the resultant capital gain will be short-term capital gain, and when the asset is treated as long-term capital asset, sale of it will result in long-term capital gains. Now coming to the meaning of these terms, Income Tax Act defines the term short-term capital asset as any security which is listed in the recognized stock exchange. If it is held for a period of less than 12 months, then such an asset will be treated as short-term capital asset. In case of shares of unlisted companies or land or building, if the asset is held for less than 24 months, such an asset is treated as short-term capital asset. And in respect of any other asset, this period of holding is 36 months. That means if the asset is held for less than 36 months, it is treated as short-term capital asset. Otherwise, it will be long-term capital asset. Now, coming to the tax rate on these capital gains, the income from short-term capital gains will be taxed at the normal rates, whatever the rate of taxation is that is applicable. On the other hand, the long-term capital gain will suffer tax at the rate of 20% irrespective of my other income. Income Tax Act provides certain exemptions in respect of sale of assets. But these exemptions are available only in case of long-term capital asset. In other words, if the asset sold is short-term capital asset, you will not get any benefit of exemption. In the case of sale of a residential house, of course, as I said, it should be a long-term capital asset. Then in that case, if the capital gains are reinvested in another house, then to the extent of investment, exemption can be claimed from tax. In the case of any other asset, maybe piece of land, etc., then the whole of the consideration, unlike in the previous case, that is residential house, you have to invest the capital gain, whereas in other cases, entire consideration, if it is invested in another residential house, then exemption can be claimed. Of course, these are subject to the specific restrictions mentioned in the relative sections. Then the capital gain can also be claimed as exempt if the amount of capital gains are invested in specified bonds, like bonds issued by a National Highway Authority or Rural Electrification Corporation, etc. But here the restriction is that this investment has to be made within a period of 6 months, and a maximum amount that can be invested under this section is 50 lakhs. Now let us briefly see some of the precautions that may have to take when we sell a property. First and foremost, valuation of land or building. If the property that is sold is land or building, it cannot be sold for the value which is less than the stamp duty value. In case it is sold as such, that is sold for value less than stamp duty valuation, then for the purpose of taxation, the stamp duty valuation will be treated as the amount of consideration received. Whether actually you receive it or not, it will be treated as the consideration received, and tax will be attracted accordingly. Okay. And in case you decide to reinvest in another residential house, this investment has to be made within 2 years or 3 years. Like within 2 years, you can buy a house, or within 3 years, you can construct a house. Suppose you are not able to either buy or construct fully within or before the due date for filing the relevant income tax return, then the proceeds, either capital gain or the consideration which has to be invested, must be deposited in capital gain deposit scheme with banks. Suppose you have entered into an agreement, okay, for sale of a property, and some amount of advance is also received, but for whatever purpose the sale does not take place, and you get to retain this advance received, then in such a case, this amount of advance that is retained by the seller will be treated as income. And most important is the transactions in cash. Okay. Income Tax Act says whether the consideration or advance should not, in the case of sale of property, should not be received in cash in excess of 2 lakh rupees. So in case cash is received in excess of this limit, so penalty can be levied to that extent. That means to the extent of cash received, a penalty can be levied. Coming to the purchase of property, first and foremost, you should be sure of the source of acquisition. That means the department asks you to explain the source, you should be able to explain that the source is out of the income which is already declared. Okay. And coming to the valuation, in the case of seller, I said the stamp duty value will be treated as the consideration received if the sale value is less than that. Similarly, in the case of buyer also, this difference will be treated as his income. Okay. So if the value of property sold is less than stamp duty value, the difference will be treated as income in the hands of the buyer also. Then in certain cases, tax deduction at source may be attracted, and certain high value transactions get automatically reported to the department, and the department can keep a watch on such transactions like shares, mutual funds, debentures, or cash deposit or withdrawal, etc. in an excess of 10 lakh rupees. Okay? Or purchase or sale of immobile property in excess of 30 lakh rupees. Okay? Or payment by credit card again in excess of 10 lakh rupees. This is not one-time payment but aggregate payment in a year. Okay? And cash received against sale of goods in excess of 2 lakh rupees. All these get reported to the income tax department. Now similarly, in the case of immobile property, if the sale consideration is 50 lakh or more, the buyer will have to deduct tax at the rate of 1%. Now let's see the transactions relating or which are called as gifts. Now when we come to gift, earlier there used to be gift tax. So the donor had to pay tax on the gifts made. But now a donor need not pay tax, but the provisions of clubbing of income would be attracted. That means suppose person gives a gift to his spouse. Okay? Then in that case, income arising from that asset will be clubbed in the hands of the donor. Similarly, gifts made to minor children, the income arising out of that asset will still be considered or taxed in the hands of the donor. Now coming to the donee, if the gift is received from non-relative, non-relative means any say lineal ascendant, descendant, etc. So if gift is received from a non-relative, then such a amount, value of that gift will be treated as income in the hands of the recipient. Finally, let's look into inheritance. Okay. Of course, in the hands of the deceased, there will be no impact because no assessment can be made on a deceased person. Now, coming to the recipient, the income from the asset would be taxable in his hands. Like for example, if you inherit a house, income from the house will be taxed in your hands, not the value of the house per se. Okay. Or if the sale, the property is sold, inherited property is sold, again the sale consideration will be treated as capital gains. Okay. But to treat it as a capital gain, cost of acquisition will be as applicable to the original owner. That means suppose person inherits property from his father, then the cost will be the cost incurred by the father for the purpose of capital gains. Similarly, the period of holding, that is to decide whether the transaction is a long-term capital transaction or a short-term capital transaction, that would be decided based on the period of holding from the date of acquisition by the original owner. Okay. Yes friends, that is what I had in this video. In case you have any queries, please leave a comment. Thank you.